12 minutes.
Okay, perfect. Thank you so much. So thanks for inviting me to discuss this very interesting paper. I understand the paper is very much on the move, so I'll try my best to capture what is in there. So what is the main finding? The taxation of Bitcoin was pretty unclear for a long time, and the authors investigate how tax effects affect Bitcoin trading. So there's kind of three studies in the paper. So one is in this individual trader data, where we look at US tax compliant traders, and the main finding there is that they have fewer taxable events, and they tend to trade more on regulated exchanges. There's many findings on there. I'm just have to focus on a few here in this discussion. There's an interesting section on DeFi data where they look at lending rates and NFT sales and look some end of the year effects there. And then there is data on wash trading, and there's some very interesting data set here, and they find that there's more wash trades in December when Bitcoin prices fell to harvest some tax loss. So almost 3 papers for the price of 1. So let me try to give a few comments on those. So on the trader behavior side, so maybe one concern I have is that maybe these tax compliant investors might be fundamentally different from other traders. There might be some unobservable characteristics here that we have. Maybe they are less subject to behavioral biases, and this is why we have fewer taxable events, why they don't sell that often. Maybe they choose the same exchange based on the same unobserved characteristics, and maybe the exchange could also influence the trading behavior, maybe fees or reward schemes that we have. So maybe there is some endogeneity there. So in some version of the paper that I had, there's a debate about whether the 2017 spike in Bitcoin can be due to the tax effect. And the story was that investors flee the altcoins to the increased enforcement and invest in Bitcoin. That causes prices to go up. And after the tax year, the price drops. I think that would be very interesting, but one could potentially consider also a lot of alternative explanations for that. And it would be interesting to see how many, or get at least an estimate of how many investors are taxable in the US and are tax compliant out of the people that trade, and how much that drives prices. So in the DeFi part of the findings, I think this is very interesting. Obviously, the boom in NFTs was something that was very interesting to observe. But there's always other effects happening too around these year-end effects, right? So the story of NFTs are pretty short, the time series, and if you look at prices, we do see that, for example, in 1929 and to 20, there was a big change, it seems, in the price of ETH around New Year. We see a similar picture for 2020, 21. Maybe that is also tax-driven, I don't know, but maybe it's hard to say whether the causality goes from the ETH price to the DeFi findings that the authors observe, or whether it's the tax effects driving the ETH price. Kind of hard to say. So on the third part of the findings on the wash trades, there could be potential other reasons why we see these wash trades come up, especially at the end of the year. So maybe the exchange wants to be the biggest exchange on the leaderboard for the year, and maybe there's some tournament behavior which we've seen in mutual funds, where exchanges find that usually don't fake volume, find it very tempting to fake volume at the end of the year because they just want to be ahead of somebody else. So Binance wants to be ahead of Coinbase or whatever. And maybe one way to achieve that is to engage in fake volume. And one could think that this is potentially more interesting, but the temptation to do that is higher when Bitcoin prices fell recently, because then the competition for market share is even more important than at a time where Bitcoin booms, where everybody is trying to get into this market and there's a growing market of traders that want to do this. So one way to test this is to look at decentralized exchanges, and it says a few differences. So first of all, we can really identify the person who is trading by looking at the wallet address. And second, these decentralized exchanges have no interest to engage in a dominant style behavior because there is no owner, there is no reason to promote the DEX. So I did a very simple analysis. So I looked at the top 100 DEXs by number of trades. This was about 26 million trades. I looked for events where the same trader trades the same token pair within 2 blocks. Now, I must say that I did some simplification, mostly because I ran out of time. I did not check the amount, whether the same amount was traded, but it was at least the same person trading in time. And then I grouped these wash trades by month. And it seems that at least on the decentralized exchanges, there does not seem to be an effect that is consistent with what we find on the centralized exchanges. The last question I think would be interesting to discuss a little bit is how will this behavior change market outcomes? So the volumes are inflated, kind of know that, and how will this, the question is, how will this impact market efficiency? Maybe it will steer traders to the wrong exchanges or something. And these December and January effects, we also see in traditional financial markets. So the question is this very different? Will this distort markets in one way or the other? And what should we consider in research when we look at the data going forward, with given that we understand that there's some tax implications? So I encourage the authors to discuss this a little bit more. So that's it. Thank you.